Hey guys, welcome back to another video, and today I'm here to go over a option trading strategy that is, considered one of the safest option trading strategies, and kind of just go over the basics of how the strategy works and, kind of how to do it with different levels of accounts. If you have a smaller account, sub 10,000. If you have a bigger account between 10 and 100,000, and then I'd say a large account, 100,000 plus. Once you're in that six-figure range, that's when a lot of money starts being made. So yeah, without further ado, let's get right into the video. But before that, be sure to smash the like button and also subscribe to the channel if you enjoy this content. I really appreciate you guys for supporting the videos. It means the world to me. And yeah, let's get right into it. So the strategy I want to talk about today is wheeling. Wheeling stocks, the wheel strategy as it's called, is when, for example, let's take a stock that hasn't been doing the best lately. Let's say Nike, and you're thinking, all right, Nike, let's go out a little bit, and we see Nike's dropped a lot. Nike's really cheap, and I like Nike. I love their stock. I really want to buy some Nike stock because they're so cheap. So we go right here, and we're like, okay, I really like Nike. I think that they're probably going to go up soon, or maybe they're not going to go up, but I want to buy 100 shares right here. So what you can do is, usually the best premium is collected between 30 and 45 days till expiration. So for this example, we'll do the 41 day till expiration. What you can do is you can sell a put. So you're selling to open. So, excuse me, if I were to buy a put right here at $57 for Nike, this basically means that when I buy this put, we can see right here, if I were to almost buy it, I'd get paid $176 in premium because I'm buying 176. I'm buying 100 contracts, so it's just this times 100 because that's the price for each contract. And so I'd get $176 in premium, or I guess $175.96 because Robinhood charges a regulatory fee. I didn't know about that, but that's what I'd get in premium, and I'd buy this, and I'd hope that Nike, I'd hope that it doesn't go to $57 or just right above $57 because then I'd collect my $176 in premium in these 41 days of waiting, and I wouldn't be assigned shares. But we can see right here, if Nike does go down, or we lose money if Nike goes down to $55. We'd lose 4%, but this is all, unrealized loss. So if Nike is at or below $57 on our expiration date, we're assigned 100 shares of Nike, and we just have them as shares. So you're getting Nike for a cheaper price, and the premium's higher than it would be if we go down the chain. Or actually, it seems like the option chain, something's a little wrong here. There's not a lot of volatility on the Nike option chain. But, if we go down more and more, we'd see that when we open one of these, it's going to pay us less and less because the odds that Nike will drop this low are lower and lower as we go down. Let's just check a stock that has a lot more volatility. That was a bad example, Nike. But we can see Amazon right here. If we go to 41 days, June 6th, if we were to sell a put on this one, we can see an accurate representation of the farther down you go, the cheaper the contracts get, the less premium you collect for opening or selling to open the put. So we can see, like, if we want to have one maybe with, a 20 delta, negative 20 delta, so about an 80 delta if you were to buy this. We can see right here that, this is one that I don't think I don't think Amazon's gonna hit $170 anytime soon. So if it does drop down there, then I'd definitely be willing to buy Amazon for $170, like no doubt about it. And I was gonna buy 100 shares anyways for $190. So you may as well just buy, a cash secured put and get this $256 in premium. And so that's where the wheel strategy comes in. So if I were to buy, let's say I bought this 170, I sold this $170 put, and so I'm gonna open that one up. You have to have the same amount. You have to have this much to open it, which I don't have in my account. But that's when you decide on different stocks. So a stock that I'd actually wheel right now, that I think is a good stock to wheel, is SoFi. The premiums on their options are decently high. There's a decent amount of volume, and I like the company. I think SoFi is a great company, and I would not be complaining if I was assigned shares of this stock. So we can see right now that the option chain here, it's not insanely populated. There's not a lot of people buying options on this. But let's say I want to buy this one right here. So I like this. I say, okay, I really want to buy SoFi, and I'm happy to buy it at $12. So I get my $81 in premium, and I'm holding this. And let's say SoFi on June 6th is $11.50. And I'm assigned 100 SoFi shares at $12. So I own 100 SoFi shares at $12. I got my $81 in premium. And then when I'm owning those SoFi shares at $12, then I'll sell calls against my SoFi shares. Because I already own 100 for the collateral, I'm selling a covered call. So this is when you'd sell a call. So I own my 100 SoFi shares at $12, so I can sell a covered call because I have 100 shares of the company in my possession, in my portfolio. So let's say I really want to hold on to SoFi. I don't really want to give it up. But if it does hit $16, then I'd be willing to part ways with my SoFi shares. So we can see right here that if SoFi, we get $30 in premium, we get the $30 no matter what. And if SoFi doesn't hit $16 or go above it, then we collect our $30 in premium and we're done with it. The contract expires worthless and we get our $30 in premium and we still have our 100 shares in SoFi. So best case scenario is that SoFi goes to $15.99 on expiration, because then we got our max gain possible without losing any gains. Because the only risk of the wheel strategy, well, there definitely is risks to the wheel strategy, of course, but if you are buying companies that you were going to buy anyways, I just say it's kind of mitigating your risk on the risk you were already going to have buying the company. Because if I were to buy 100 shares of SoFi right now at $13, why not lower my risk and buy SoFi at $12 for a lower price? And if it doesn't drop, then I didn't risk anything. It just goes up and I get to, keep my premium and I never get assigned any shares, which, you have to be fine with that too. You can't be chasing the stock. So you'd have to be okay with that. And then, if SoFi did hit $15.99, I have 100 shares, so I'm gaining the value of those shares going up. And also, I didn't get assigned my contract, so I wouldn't have to sell those shares. And maybe the next day it'll explode to $20. And after my contract expired, I can buy, a 25, or I can sell a $25 call or something like that. So the wheel strategy, it's really not that complicated once you get the hang of it. You just have to understand that you have to have the collateral. So what I like to do is, you just, if you're going to sell a put on SoFi, and let's say you sell the $12 put, you have to have $1,200 because you have to be able to buy the 100 shares at $12 minus the premium right here. So you can see right here, it tells you, if you check right here, your max loss this is if SoFi, the stock went to $0, your max loss would be $1,119. And that's how much money you have to open this contract as well. So definitely not, comparable to bigger companies that, it just depends on how much each share is worth. That's kind of what makes the option more and more, harder to open for small accounts, because the bigger the stock, the more secure it is, the more likely you're going to say, okay, I want to own 100 shares of this company. Like, if you were to own 100 shares of a company and it was SoFi or Amazon, I think most people would probably choose Amazon, which is understandable. And Amazon is a lot more widely recognized. It has less risk. It has a lot more of a financial backing, which makes sense. So we can see that if we bought Amazon, if we wanted to sell a put on Amazon, June 6th, we'll do 41 days. And we say, okay, this one looks good, the $170 one. If we want to sell a put, we get $256 in premium. That sounds great to me. I'd love to buy Amazon right now at $189. I'd double love to buy Amazon at $170, though I'd be ecstatic if I could buy Amazon at $170. So if it drops, I'm completely happy with that. If it drops to $150, I'm still fine buying Amazon at $170. That's the mindset you have to have, because you're going to get assigned right there. But we can see right here that you have to have $16,744 to open this one. That's a little bit more. That's about 10 times more almost. So we can see right here that it definitely does depend on the price of the stock you're trying to buy, because then we can go, we can look at SPY. Some people like to wheel SPY, which is not a horrible strategy in my opinion. And we can see that, the more expensive the stock, the more and more expensive the wheel strategy gets. And it gets expensive very fast, but we can see the premiums also do get higher, which, is nice to see. But yeah, it does. I mean, you can see right here, just to get this $1,200 in premium, which $1,200 is a lot, but you have to have $54,000 to put up as collateral just to get that little 1,200. In comparison to the 53,487. That's a hefty chunk of change for a lot of people. For me, it is. So that's, I mean, that just goes to show how the wheel strategy definitely, it can rack up a lot of, expenses. You have to have a lot of money in your account to buy the bigger stocks, but there are small ones. Like I started the wheel strategy with Ford stock right here. This is what I first started the wheel strategy with, and it taught me a lot. Taught me a lot on how the options work. So I think this is a good one to start off with if you just want to learn the wheel strategy. You know, I don't know if I'd actually want to own Ford, the company Ford. So I mean, I would personally start in this moment in time with SoFi because I think the premiums in relation to, I mean, I'd want to own this company at $12. I'd be fine selling puts at $12. That's up to you guys if that's what you want to do, if that's the risk you want to take, selling SoFi puts at $12. But I definitely would want to own SoFi puts at, or SoFi shares at $12. So I'd be, completely fine with that. And yeah, I mean, I also, another thing you can do that isn't the wheel strategy is you could just buy 100 shares of SoFi right now and then sell covered calls against them. The only thing this does is that if SoFi were to rip past your price on your covered calls, it kind of, the selling calls against the stock, definitely gives you a little bit of, okay, the stock went down. I feel a little bit better because I collected $34 in premium and my shares went down, every share I have, SoFi's down, $2 on the month. So I'm down $200 because I own 100 shares of SoFi, but I got $34 in premium for selling this covered call. That's great, but if you think the company, I mean, it gets more expensive near here for a reason because if I buy this $13 covered call and I own 100 shares of SoFi at $12.96, if SoFi's stock is valued, if the stock price is above $13 on June 6th, which if I had to guess right now, I'd say it would be, then all my shares would get called away and I'd make, let's say I bought the SoFi stock at $12.96. I bought 100 shares. I'd make $4 from, the stock appreciating 4 cents. But even if SoFi was worth $100 a share, that's all I'd make is this premium and then however much my stock appreciated all the way to the strike price of the call that we sold. So it can get confusing. But that's why, I mean, if it blows past this, you definitely lost out on a lot of potential gains. But that's the only risk is losing out on potential gains. That's not that bad. I mean, you still made money. It would definitely hurt a little bit, but at the same time, you can't have emotions when investing in the stock market. That's, just a given. But I mean, then you get into the depths of, stocks like AMC and GameStop, and these stocks with high volatility offer very high premiums. But I have to ask you guys, please do not fall for this trap unless you truly believe in AMC. Because look, you have to, I mean, look at right here. If I were to sell puts on AMC for, I'd have to put up, how much is this in collateral? I'd have to put up $236 for 14 cents in premium, or $14 in premium, which when you do the percentages, that's pretty good. That's almost 5% in 40 days. If I can make 5, and then you start doing math in your head and you're like, oh, if I can make 5% every 30 days, and then that's 5%, and then exponential, and then plug it in a calculator, and then you're like, okay, I'm going to be Warren Buffett. I've gone through that before. I've definitely, looked into the future a little too harsh, or, I've definitely gotten a little bit over my head in the past looking at these numbers for stocks, especially like AMC, GameStop, these cheap stocks where you only have to have $236 and you're making 5% on your investments. So you could, what if you did that every month? You made 5%. I mean, let's just put it into perspective, actually. If we check a stock investment calculator right now, this is one I like right here. But, I mean, we'll use the years as months because we'll say it's compounding as well. So let's say you do this for 2 years. So each year is a month. That's what we're doing. And we're saying that you're making 5%. I mean, let's just use this as our base case. So, this is $236 up and you're making $14. So we'll say, we'll just round it. We'll say 5% about roughly. And let's say you're not contributing anything and you're starting with $1,000. That's it. And you're making 5% every month for 2 years. you tripled your money. So I mean, that's just like, that goes to show that this can definitely work very well if you really study the stock and you're really into it. It can definitely work very well. And I mean, the longer you keep this going, the more consistent you are. Let's say you do it for 5 years, you 18x your money. So I mean, it's a little blown out of proportion right here, but you can see that this strategy can definitely yield a lot. But the question is, do you want to own 100 AMC shares? Probably not. Maybe you do, and that this strategy is for you. Selling a put at this price is for you if you want to own 100 AMC shares. I personally don't want to own 100 AMC shares, so I'm not going to do this to AMC stock, but for SoFi stock, I'll do it. There's definitely other stocks here too that are pretty cheap that I do it for. I'd say Fubo. And then we go down here and we can see Honest. I definitely do it for Honest. Love this company. So I would definitely not hesitate at all if, $55 put, if I were to sell a put. They don't even have any. That's the thing also, they have to have a decent amount of option volatility. Like you can see, I want 100 days out, there's nothing. And then 200 days out, 10 cents in premium. That's not enough, but I mean, you look at the option chain, and it's a big discrepancy. It's a lot closer to $5 than it is to $4.70 now. But yeah, guys, that's all I have for today's video. I hope that helped out on what the wheel strategy is, and I hope that helped you guys understand it. If it didn't, I can make another video clarifying it a little bit more. I'm new to it myself. I'm just thinking about starting it right now. I've known about it for a while. I've tried it in the past. But I definitely think that there is a lot of money to be made when it comes to the wheel strategy, and it's a great way to, outperform the market in the long term if you can really get it down. So yeah, that's all I have for today's video. Be sure to smash that like button if you didn't already, and subscribe to the channel if you enjoy the content. I really appreciate it. And comment down below what other videos you guys want to see. I'm open to anything. And yeah, I appreciate you all for watching. I'll catch you in the next one. Peace.